Good afternoon, Jax. This is Fahad. Today is Thursday, November 29th. Let's get started. Sorry, I was taking my time to start here because just trying to get my head around exactly how we're gonna proceed from here going into the G20 meeting. I think it's gonna be a major volatility on Sunday night futures, but what I'm really trying to figure out is whether it will have any lasting impact per se. And as a result, is there any need to make a any concrete bet going into it in anticipation for it? Because let me just put my logic around it and see if it makes sense. What's most important thing over here? Is it China or is it Federal Reserve? The rally that we saw in the market yesterday, if I go back to this SPY chart, and the rally that we saw in the market yesterday came on an exceptionally strong volume. It was one of the most powerful rallies, and it was the participation behind it was pretty broad based. It was across the entire spectrum, all sectors combined. The internals improved on that rally significantly yesterday. And overall, the breadth indicators from yesterday's market close and today so far are all holding rather very strong. I mean, there was a little bit of a shakeout moment earlier today. We saw a little bit of a profit taking in the morning, mainly driven by more headline risk or whatnot. But the way we're holding, and in fact, I'm looking at some of these internals, they are generally improving, since the market gapped down a little bit. There seems to be quite a bit of, let's say, comfort that the bulls have at this time. I get the sense that the bulls are generally comfortable with the way the market is acting after what Jerome Powell did yesterday. Now, just to kind of guide you on that real quick, Jerome Powell's news yesterday essentially took the took the number of rate hikes that were on the table in fiscal year 2019 from three dots to just one dot, and we don't even know when that's going to happen. It is very likely now that you're going to get a rate hike in December, and you're not going to get a rate hike in March, and the next one may not even come until June or maybe even September. Probably going to be in June or September next year sometime. So basically, the Fed is now on hold for a long, long time. Probably no more action after this December FOMC meeting that is coming up, and that gives a incentive for the markets to basically, it's a risk on moment where we're not going to worry about the punch ball being taken away. So let's start buying high growth momentum names as well. So that's why some of this price action that you're seeing has been the strongest in the growth areas of the market, particularly those that are in the software group yesterday. If you type in the symbol IGV, which is the ETF for just software stocks, that's where you saw the biggest, most robust rally after that FOMC, after Jerome Powell comments yesterday. So my question here is that, does it really matter what happens in the G20 meeting this weekend? Would it really matter at all? Or Jerome Powell has now basically, or Powell's put is now behind the market, which is much more important and significant that as long as he's there and as long as he's got this, Powell put underneath it, we're not going to really see any kind of sell off. Even if there is no deal, if there's nothing, we're simply not going to have the kind of breakdown in momentum anymore going into this G20 meeting, because the Fed is basically no longer hiking. It may very well be the case you're not going to see after December the next rate hike for 9 months after that. That's what the odds are now essentially setting. So we have a complete drastic shift in monetary policy at this particular time, right? So that's how I'm trying to interpret this data. I think if these comments from Jerome Powell hadn't come out yesterday, then I may have a different look at this time, because it's all about how the market is going to react to certain catalysts and moments, and I may have had this idea that, hey, the risk is much higher or elevated because I don't expect anything good to come out of the G20 meeting. So why not have a hedge or something? And I think it may still be the right approach to have at least some hedge going into G20 meeting. But at this point, I've gone from being cautious as of yesterday morning to now being, you know, neutral to actually, potentially even bullish actually going into the G20 meeting. The reason is simply because I think if you get a deal, something good happens with China, which seems to be there seems to be a little bit of momentum building behind this. I mean, yesterday morning in the chat room, right? Yesterday morning in the chat room, I showed an article from New York Times discussing that politically Trump cannot risk this meeting. Uh, you know, uh, Politically Trump has to make a deal basically, and he doesn't have the capital, the political capital, to basically risk not making a deal going into this G20 meeting. So something is going to happen on the positive side. That was New York Times yesterday, and today, just moments ago, I was discussing how Wall Street Journal is now talking about that there's going to be deal to be made at the G20 meeting. So at least these are telling us that. And then when you combine that with these Jerome Powell put that's now underneath the stock, I think that you may now have a scenario where your market may actually rally next week. Now, whether it's going to hold on to this rally early next week when you get a spike higher or whatnot, that's to be determined. Not exactly sure because we're going to ultimately fall back after that. Couple of days later, we're going to fall back to looking at the macro data environment, and then we'll see if that's gonna lead us into any kind of different picture for the market. But I think I think Powell is more important here than China. That's the way I'm interpreting this market right now. So. Maybe one step back, but I think a potential as much as three steps forward in the market. So, however you want to interpret it, one step back or three steps forward from here after the G20 meeting next week. So, as a result, I have decided against buying any kind of straddle. I was thinking about it in the last webinar, but I think the volatility will get crushed. I think you're going to see VIX absolutely get crushed next week. VIX may actually come down to below 15. We'll see. So I have decided against buying any kind of straddles or strangles that I was thinking about in SPY, and I discussed that briefly on Tuesday. Um, I may still change my mind because, folks, again, this is how the market is, right? I mean, we have to look at day to day, headline to headline, literally hour to hour, and sometimes minute after minute. Things get so shaky at the moments that you have to immediately look at from different angles to see what you're going to do. I may still change my mind by Friday before market close, and then if so, I may still issue an official trade idea just to have some sort of hedges in place, like maybe some SPY hedges, some short-term, very short-term puts or put spreads or put butterfly spread, just to be on the safe side. But I feel like I have enough balance on the books right now anyway. I mean, for example, we got puts in some crude shorts. We got puts in some of the SAMIs that we have discussed. We bought puts on Tuesday in the industrial. So I think overall the balance is okay, and the portfolio is fairly balanced at this time. So I probably don't need to buy any more puts. But at the same time, I think that generally speaking, the sentiment I think changed a little bit for the better after those comments from Jerome Powell. So that's what I wanted to start off. Overall, technically speaking, as you all saw, this is where the S&P stopped yesterday was literally almost like to the point downtrend resistance that begins from when this market started to sell off on the 1st of October. So we perfectly stopped right there. Now, previously when this happened, we had a doji candle too, and then we rolled over. So far, it was looking like a doji, but now it's looking like a hammer reversal candle a little bit. Market is holding pretty good overall. So I think that we may have a breakout coming this time in through that downtrend resistance. I'm looking at the up and down volume ratio, flattish. It's not getting destroyed. I'm looking at the S&P put and call over ratio, pretty normal. No anxiety, no trouble, no troubling things to see over there. Uh, Participation is not as robust, but today is sort of like a digestion phase in the market after after what we saw yesterday. after a huge rally. So it's constructive price action overall, taking a look at the market. One area I want to touch upon extensively is going to be crude oil, because I'm sure many of you will have questions about this. Now, I was up. I was up really early this morning. I woke up just before 3 o'clock in the morning Eastern time. Couldn't fall back to sleep. That's because of my son Liam, who kept me awake. And then I've been up since about 2:30 or 3 in the morning. Anyways, when I was up, I simply came into my office, started looking at some charts, and I saw the crude oil took a sharp dive around 3:30, just as European markets were opening, and went straight down to $49.40. And but then the news came out about 2 hours later, around 7:30 in the morning Eastern time, that Russia is working with Saudi Arabia to basically get the crude oil to go back to $60 per barrel by trying to identify the right level of production cuts and or that is needed to basically prop the oil back to $60 per barrel. They don't exactly know how much crude oil has to be cut as a result to get the crude oil to 60, but they talked about that's the level that OPEC, particularly Russia and Saudi, feel comfortable, because it's the level where the U.S. shale gas industry can survive, and at the same time, all the international players, particularly in the OPEC countries, can also survive and be happy. So that news that it could, that they want to take the oil back to $60 per barrel, and they want a flat line over there. Now that means they're going to do production cuts depending on price action in crude oil day-to-day basis, and that's what reversed the crude oil higher. And now we have a little bit of a bullish engulfing candle with crude up 3.6%. Purely looking at technically today, just today, this is a constructive candle. I have to say, this is a bullish engulfing candle. We had a breakdown and then a reversal, right? So it becomes a bullish engulfing candle, leaving a tail behind it. As a result, there's a possibility with this news out there, purely technically speaking, and looking at crude oil, you may have a short-term rally in your hand that's going to go up to about $56 per barrel, where the volume of price support or resistance, I should say, starts to come into play. That's about this level, $56 per barrel. So you could get a little bit of a rally in the next days or couple of days with this news out from OPEC, but I think it's going to fail there. It may even come short of even reaching $56 per barrel, and I think it's going to fail there, and it's going to start rolling over. And I think that's when some of these shorts in the energy space that are bouncing in the short term will look even better, more constructive shorts once we get that bounce up to $55, $56 per level. So I want to show you a couple of things over here. There is a article that was put out by Bank of America yesterday, as well as some other analysts as well. Come on. That talked about what all this means for crude oil in terms of 2019 and going forward from here. I think it's going to give you a lot of color that you can keep in mind. Now, Bank of America believes that from here, a balanced U.S. market requires a step up in exports. The OPEC plus supply cut of 1 million barrels per day versus the October level, or 1.5 million barrels, was higher in November levels, could be the catalyst needed to pull more stocks out of the U.S. But we'll have to wait until December 6th to see how the regime plans to bring balance to the market that has seemingly been surprised by the U.S. policy. Now, so that December 6th that is mentioned over here is now become a very important key OPEC meeting. So you may see a rally in crude oil in anticipation of potential production cuts after what Russia said this morning that gave a jolt overnight, right? Jolt overnight. I think there's a potential here that you may see crude oil continue to gradually rally here a little bit all the way up until December 6th. Now, today is November 29. December 6th is exactly 1 week from now. You may see a little bit of a bit of a weak rally in crude oil, just a slightly uptick. But then it's going to depend exactly what kind of production cut that's coming. And according to this note, what it's telling me is that an OPEC supply cut of minimum of 1 million barrels would be necessary to bring the U.S. Market back in balance. Because remember, what has happened is that the U.S. Exports of crude oil have significantly, basically just disappeared because China is no longer buying our crude. Therefore, the cuts have to take place someplace else. So the calculation, the way it works, for according to Bank of America, is a million of 1 million barrel cut. To be honest with you, the reason where I disagree with Bank of America and why I believe crude oil will fail once it gets to 55, 56 is because I believe 1 million barrel will not be enough. Because the way we are actually seeing the EIA data and the API data continue to go up inventory wise, it is in several millions of barrels every single week. So I don't know how 1 million barrel per day is going to actually take that capacity, keep the, reduce, turn that inventory chart the other way around. I think it's not going to happen. And if we get any kind of further deterioration in the international PMIs, particularly China, which has seen significant drawdown in the PMIs and the leading indicators, I think that is going to only exacerbate the problem of the excessive inventory of crude oil that is coming up. So my point here is when it gets to 56, I think you're going to have a really, really good short in crude oil. Another one I want to point out is right here. Total crude oil inventories of 450 million barrels today are up 56 million barrels just since September. While the inventory bills are typical for the season, which we are seeing right now, this is easily the steepest build ever. So it goes to show why I become so bearish on crude oil recently, because even after you take into account the build that generally happens during this time around, this build that we have seen in crude oil is the steepest ever. I'm not the only one. Bank of America, which has a constructively bullish view on crude oil overall, just like other analysts, has been talking about this. Here's another chart that shows you exactly what's going on. So crude stocks, these are not equities. Crude stocks means crude oil inventory. That's what it means over here. These are inventories. Take a look at how the 5-year average, you start to see the dotted line over here, a little bit of a pickup in the crude oil inventory build. And then it follows, it tapers out around November, and then we start to see a decline in crude oil inventory. This is the 5-year cycle that usually plays out based on refinery shutdowns and a whole bunch of other factors. Last year, 2017, you saw the same thing. 2017 was a very steep decline. There was a very minor pickup in inventory, a minor build in inventory during the seasonally strong period. But then going into year end, 2017 saw a very steep decline in inventory. That's why last year, you guys may remember, if you go to, for example, if you just pull up the chart of XOP, right? Just go to XOP and go to the weekly scale. You may remember that last year we had a huge rally in crude oil in the final 3-4 months of 2017, right? There was a massive rally in XOP and the and XLE components. That's because the crude oil inventory in 2017 going into year end was coming down sharply. This is complete reverse. This 2018, we are still building. I mean, by this time, whether you look at 5-year average or last year, by this time, this chart, the inventory build should have already started to roll over. It's not happening. We're still steep, just building inventory nonstop. And there's no sign. We are now already in December, and it's showing just no sign of basically coming to a tapering formation at the top. So that's why I'm so bearish overall on crude stocks. Here's another chart that I can show you that goes around this. This is the crude production. So take a look at the spike in crude production. Another reason why the crude price was so strong going into the end of 2017 and then beginning in 2018 and then continued is because going into the end, take a look at 2017 going into the year end, the crude oil production collectively by the U.S. shale gas producers wasn't really going anywhere. It was sort of flattish. It was slightly inclining, but it wasn't parabolic. And what has happened in response or in expectations of of a potentially and probably incorrectly, uh, with the industry assuming that the growth rate will remain robust, the 2018 production in the U.S. shale gas industry has really gone parabolic. I mean, it was already strong all year long, but in the last couple months or last 2 months or so, it has gone completely to new heights. So you've got inventories coming down, which is what this chart is showing, right? Oh, inventory is building sharply. At the same time, crude oil production rising sharply. And at the same time, these are the factors what makes me believe that the crude oil may get some dead cat bounce based on the expectations of something good will come out on December 6th. But I think at that point it's going to fail and it's going to roll over again. I think that's a much bigger risk to a very important sector, which is about, I think, crude energy is about 14-15% of the S&P weighting. I think these are the things that are much bigger risk to what may happen to the market next week rather than us worrying about what's going to happen in China over the weekend, because I think for that, the Jerome Powell put is already underneath the market. Another thing I want to show you is this is very interesting. So one of the things I talked about in my Hess articles and some of the other energy articles, and then on Tuesday when we talked about the bearish play on the EMR, I talked a little bit about this. One of the most important things that are going to happen is that in the last 2 weeks of December, you're going to start seeing capex budgets for fiscal year 2019. They will start to come out from large integrated oil companies. And when that happens, you're going to see those capex cuts. I want to show you where those capex expectations are currently. These are 20-year 18 expectations, so they're practically over now, right? The year is almost over, but this is what we saw in 2018, and I think this is where you're going to see cuts. So take a look at where the major oil capex changes are right now. This is every large capex. Obviously companies like uh, uh, Royal Dutch Shell and the Exxon Mobil's. They are some of the biggest ones. Take a look at these growth rates they posted in the capex environment 2018 year over year. So the whole industry is finishing the 2018 year with a capex growth of about 22%, which actually has increased in the since the last update, which was only a month ago. So this is as of the end of October. As of the end of September, it was actually at 21% year over year. Now it's 22%. I think this 22% will get slashed. I think that 20% could get cut in half, maybe even more, maybe down to single digit percentage. And I think all that data, all of these oil companies are going to start showing, are going to start providing their fiscal year 2019 guidance and outlook at the end of 2018 in just a couple of weeks. So I think this number is going to get cut. When that happens, I think you could see some chaos pursuing in some of these industrial names such as EMR. In fact, it is already beginning. This is the article from Bloomberg that was published this yesterday yesterday night. Last night at 7 o'clock. I posted this in the economic news today. Top economic news. You can see right there, shale patch expected to cut budgets for first time since last crash. And here's a very important analyst that follows the energy industry very closely, Wood Mackenzie, saying we expected some minor increases in budgets going into next year, but now we see a risk to the downside with budgets flat to down next year. And the last thing I will tell you is here is EMR. So this gives you another idea that back in 2016 in EMR, we saw how the growth rate during the slump period in the energy sector, we saw it was consistently negative, and then coming out of the slump, the growth rate, the bookings growth rate in EMR slightly turned positive. It hit the high point of 15%. It has been sort of sustaining that momentum, but I think this 11% growth year-over-year growth rate is going to start to come down sharply in EMR bookings if crude oil continues to remain under pressure. So here's the bottom line. I showed a lot of chart. I've been building on this message now for a couple of weeks in the crude oil. So this is the same message over here. You're going to get a little bit of a bounce based on what OPEC is trying to do over here, but I think it's just a sentiment, just oversold bounce a little bit in the short term. I think December 6th next week is going to be a disappointment for crude oil as well as the entire energy sector. And I think that whatever the good or bad is going to come out from this G20 meeting probably not going to matter much because Jerome Powell, has already has a bit underneath this market with this dovish commentary. But I think then once the G20 meeting is over, we're going to fall back to actually assessing this market on a fundamental basis, right? And then means returning back to looking at how some of these end markets are doing. And I think that if December 6th OPEC meeting turns out to be a disappointment, there's another 15% weighting in the S&P 500 index that's going to potentially hurt this market at that point. Okay, and so not only crude oil, the entire industrial sector, and a whole bunch of other things. By the way, also you should know that a week after that, a week after December 6th. I think it's December 15th, but don't quote me on this because we'll find out exactly. But sometime in the middle of December, you're also going to get industrial production IP data, which is going to be very sensitive for the industrial stocks in general. So here's my whole overall thinking is, if this market rallies next week, after G20, based on whatever they come out, I may then use low VIX cheap put options at that point then to enter and actually suggest a hedge going into the OPEC meeting, which is going to be on December 6th, which is Thursday. So at some point, you may see volatility come down sharply right after G20 during the early part of next week, Monday, Tuesday, let's call it. And I think that may then provide a really, really attractive entry to then just have some hedges in place, maybe even sell some of the positions, some of the bullish positions that we have, and then just lighten up a little bit and then have a hedge in place for the OPEC meeting on Thursday next week. So just an overall thinking. Let's see if this develops into anything, but I just wanted to put it out there. Okay, I have one